On the whole, in 2025, the markets are down, and today we want to cover race, better known as Ferrari, which is actually up, although marginally around 3%, is trading near its 52-week lows, and also down around 20% from its all-time highs, with both Wall Street and Seeking Alpha calling this company a buy to the portfolio. They too pay a dividend, although on the low end at 0.6%. And if you've also been a shareholder over the last 5 years, you would have outperformed the S&P 248%. In comparison, S&P up 153, something that we can also see over the last 10 years, except the outperformance has been much higher, 731%, S&P only 175. Now, Ferrari designs, manufactures and sells luxury sport cars known for performance and exclusivity. They generate their revenue from car sales, customization, sponsorships and their racing division, which also competes in Formula 1, and the company also profits from brand licensing, merchandise and financial services, maintaining very high margins by limiting production to preserve exclusivity. On top of that, they continue to launch newer models, with 3 in fact in 2024, and this is a company that the institutions also like. Whilst having sold 3.4 billion worth of shares over the last year, they did buy a lot more, near 6 billion, and something we also note in the most recent quarter, more buying than selling by the institutions, so as we said, more bullish than bearish. And if we were to take a look at their most recent quarter of earnings, revenue is up double digit, 14% year on year. We do notice the vast bulk though of their top line does come from cars and spare parts, and we also get to see efficiencies on what is already some very high margins, not just comparing it to over the last few years, but also in comparison to the sector that we'll show you, up 1 percentage point on the gross, up 3 percentage points on the operating side, and up 3 percentage points on the net profit on a year-on-year comparison. In terms of earnings per share over the next 4 quarters, it is fairly mixed in terms of the growth, but still nonetheless positive, and over the last 4 quarters, they have outperformed on each one, giving them a 100% track record. Now, EPS does currently sit at 980 expected for the full year, which means they are trading at a forward valuation around 44.5, which does look very high, but as we will come to show you, this is a company that is historically traded at such a high premium. Now, when we look at the full year of FY24, we do notice, in fact, only a very small increase to the number of shipments, up 0.7%, but the ramifications of this, given how expensive the products are, is double-digit increase, 12% to their revenues, double-digit increase, 17% to their EBIT margin, the same for earnings per share, up 22%, EBITDA up 12%, and their free cash flows also up again double digits at 10.2. So this is one of the easy ways to look at the company in terms of the quality. They only need to sell a few more cars every single year. In fact, when we take a look, they've sold less than 100 cars more from FY23 to FY24 to see those ramifications right across the metrics, which shareholders will love to see. Now, the expectation for 2025 is a little bit slower. We do notice around mid to upper point single digit for the growth in terms of their revenue and the margin, with their free cash flows expected to grow at 17%. But one thing, as we did show you, this company does historically tend to outperform what they even target themselves. You probably are no surprise then that on valuation they get an F grading, currently as we said around the 44 to 45, with the sector sitting a lot low at 15, meaning right now you're paying nearly a 200% premium for the company. But in comparison to over the last 5 years, they've traded around 47 to 48. So right now, it is sitting at around a 6% discount to their historical norms, and something we do see pretty much across every single metric. If you're buying this stock, it does trade at such a high premium to the overall sector. Question is, 1, does it deserve it? And 2, how much of a premium should we be willing to pay? That is something, as always, we'll cover in the episode. Now, free cash flow per share is something we closely look on this channel, as we do believe earnings is susceptible to manipulation by management through accounting. So nice to see on the free cash flow per share growth over the last 10 years, very high, 51 cents in 2014, $5.17 on a trailing 12 month. That is a 10x and only expected to go even higher over the next 12 months. But we do also have to understand that there is a lot of inconsistency on a year-on-year basis. In terms of sales growth, over the last 10 years, more often than not, we see double-digit increases to their top line. In fact, over the last 4 years, we do get to note that, but we do have to point out the C on the growth rate. Having said that though, year-on-year revenue up 12%, well above the sector at the low single digit, pretty much in line with the 5-year at around 12.2. Forward looking, they're anticipating around 10%, well above the sector at 3, pretty much again in line with their 5-year average. But one thing that lets them down, which is why we get the C rating, is the earnings per share over the next 3 to 5 years, estimated to grow at 10%. That is lower than the sector at 11, but also quite some way below their own historicals at 14.6. In terms of their margins, very strong on the operating side. We get to see efficiencies that we always want from companies, not just increasing their top line revenue year on year, but also their margins, operating in fact 15% 10 years ago, now sitting at 27, and their free cash flow margin, whilst inconsistent, above the 5% minimum that we want to see year on year, sitting right now at 14% on a trailing 12-month basis. In terms of the profitability grade though, they get an A nice standout, 50% gross margin. In terms of the sector, it does sit lower at 38, and not far off their own 5-year at 52%. Bottom line sitting at 23%, well above the sector at 4, but actually we get efficiencies on the net margin, given over the last 5 years this has sat at 19.3, and they generate not only a lot of cash from operations at 2 billion in comparison to the sector at 276 million, but also a lot more than what they have done historically at 1.5 billion. So in conclusion, for some of these ratings and grades, there is a double buy from Seeking Alpha and Wall Street. We get an F on valuation, a C on growth, with an A on profitability. A few other things to highlight about the company. Yes, they do pay quite a low dividend, below 1%, but over the last year, they've grown it at 21%, and over the last 5 years, we maintain that double-digit increase, sitting at 21.5 year on year, and they also have a very high ROIC. Remember, this does give us faith management are able to effectively allocate their capital, well above the 10% minimum, sitting at 27% on a trailing 12-month basis, whilst also having a very strong net debt to EBITDA, reflecting on a very healthy balance sheet and dividend safety. As always, these are the number of years it would take the company to pay off all of their debt net of cash on hand, well below the 3 we want to see. In fact, from the highs of 2015's 2.93, it has been decreasing, now sitting at 0.68, and anticipated to go a little bit lower over the next 12 months. We'll also show you in terms of the income statement, their top line has pretty much doubled from 3.1 billion in 2015 to now sitting at just below 7 billion, something that is fairly consistent over the longer term. And we'll also show you the bottom line net income. Always good to see if the story matches on the bottom line, and the answer is pretty much yes, going from 313 million in 2015, now sitting more than 5 times at 1.6 billion. And we'll do the same for the balance sheet. A quick health check. Total cash has been increasing over the last 10 years at 202 million 10 years ago. Now from the latest quarter, they have 1.8 billion sitting on the balance sheet. But as always, one number here in pure isolation doesn't tell us anything, which is why we compare it numerically and directionally to their total debt. And what we can actually see, it has increased, although very marginally. In fact, this is also depicted from the graph, going from 2.5 billion in 2015 to now sitting at 3.5. So cash isn't too far off their total debt, which as we saw on the net debt to EBITDA, that does sit below 1, maintaining a very healthy balance sheet. That is always something we do tend to look at on a quarter by quarter, year on year basis. We also want to let you know we have released our latest free weekly article. We draw on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, where you can also gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then jump into our valuation, where we get to $484 derived from the DCF model, and we can in fact show you we have the free cash flow year on year, their most recent year in fact, where we see 21% on a compounded annual growth rate. Now we have gone for around 18%, as you can see, low, medium and high, 16, 18 and 20, but the numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Ferrari or any others. But based on 18% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, 484 indicating 11% upside. Now we'll also show you, for full transparency, at the 16% point, $420, indicating downside of around 4%, and for those that believe it should be a lot higher, around the average growth at 20%, $556, upside of 28. Now, typically on the channel, we do like to take through the medium rate, where we're not just done there because we apply a margin of safety. 10%, execute on that if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. So what we're saying right now for Ray stock, you are getting 10%, pretty much around the $436 mark where the company sits, with Wall Street themselves seeing this at $550 over the next year. This in turn translates to 26% upside. Now, some investors may see this as a premium stock, 10% margin of safety, more than sufficient. For those that want more, at 15%, a buy at 411. For those that want a 20%, around 387, and those at 25, around 363. As we said though, 10% pretty much bang on today's value, but we'll also show you, for those that believe the high rate to be more applicable at 20%, the margin of safety that would also be in line. And one thing to note with that price, in fact, it is around what Wall Street see, 556, 550, meaning they themselves believe future free cash flows to grow at 20% for Ferrari stock over the longer term. But let's dive into the margin of safety, which will in fact be higher. 10%, a buy at 501, at 20% around 445, and at 25, not quite there yet. So if, like Wall Street, you believe the growth rate will be at the higher end, you're looking at a 20% margin of safety. Wall Street's target, untouched, $550, 26% upside. As always though, give us your thoughts. Is Ray stock one to buy now on the dip, or maybe wait lower, or in fact not one that fits your overall portfolio? Don't forget as well to sign up to the free weekly newsletter, new copy coming tomorrow morning. Come and join us as well in the Patreon, where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.